rallying once again, and that is something that has been the trend of today's trading session. Every time there is a bit of an attempted bounce back that gets sold into as well. Now we're back closer to that 18,200 mark, and just moments ago we were a little over that 18,250 as well. So it is all over the place. We are seeing a fair amount of volatility. So long as it stays in the range, the street would be happy. But right now, it is choppiness all over, which is, of course, reflected in the way the India VIX has moved as well, now closer to the high point of trade for that fear index too. So let's get in, our alpha manager of the day, long-term focused on equities itself. We have Raunak Onkar, who's the fund manager and head of research at Parag Parikh PPFAS Mutual Fund. Raunak, I was looking at your top holdings across the two portfolios that you have, and none of them have any healthcare diagnostic holdings or any stocks, no exposure there. Do you think right now is a time maybe, or you continue to focus on the stocks that you hold, believe that these are just volatile moves and it's best avoided?
Hi, thank you for inviting me. So I think in healthcare, our strategy has been very clear to build a basket of generic export-oriented pharma businesses, which have a better balance sheet, have exposure to international markets and a diversified portfolio. In diagnostics, although the sector we track quite closely, the valuations have never been that attractive, and the listings also have been very recent. So I think giving a time frame, which is say pre-COVID and now, the business has actually performed very well, and the valuations have also caught up to that. So I will wait for a good entry point in these companies, but we keep tracking them. These are interesting businesses with great growth opportunities in the country.
Hi, Raunak. You'll have various funds out there with different allocation as well. At this juncture, given the kind of valuation on equities, given the hawkish commentary we're getting from the central banks, and now suddenly this resurgence of COVID in parts of the world, what would your advice be? Would you advise, investors to put more money into, say, more debt-oriented funds, or will you go still for the equity funds?
Actually, it's a great time to look at your asset allocation overall. If you're an investor who has been invested in equities as a larger chunk of their net worth, you can actually look at debt allocation where even short-term to longer-term debt, you're actually finding good opportunities and getting decent returns, which otherwise you wouldn't get in the past couple of years. These things have been changing over a period of time. Whereas from asset allocation point of view, if equity or longer-term investing is your requirement, then equity remains to be a good asset class to consider and keep investing in. From a portfolio point of view, I would say that we have around 13% of cash in the flexi cap fund, which has not changed dramatically. Over the past few months, we have been having a cash position, but it's not because we are hoping for a macro event or a market crash or something like that. It's mainly because the opportunities in our domestic market are not plentiful in terms of deploying capital. So our existing portfolio keeps getting some of the incremental capital that we have in the fund, where we find good ideas. The only new stock we've added is the UTI Asset Management. But beyond that, I don't think there is a very attractive valuation of any company where we think we can add immediately.
Okay. In fact, we do have, some of your funds on the screen, so we'll get them on board. You have the Parag Parikh Tax Saver Fund as well as the Parag Parikh Flexi Cap Fund. And I do notice that you still have some large cap IT players in your list, whether it's HCL Tech, Tata Consultancy, in your Tax Saver Fund. Now, if you look at Accenture's recent commentary, they spoke about how there's rising caution amongst a lot of their clients. Clients are sort of focusing on cost optimization, smaller deals are getting cancelled. Would you still keep the faith here with some of these large cap IT names, or do you think it's time to churn out now?
So with IT services as a sector as a whole, large cap or small cap or mid cap companies combined, if you see, the demand is also cyclical. It doesn't happen that you have consistently great demand. In the last couple of years, we have seen many people accelerating their technology budgets because the other incremental capital allocation was not happening anywhere, and people thought maybe transformative deals could be done when you have to work remotely. Other employees and offices across the world have to be connected. So IT services spend was disproportionately higher compared to past years. But this is a cyclical business. We don't have to forget that, and we need to understand that as companies scale their budgets again from smaller deals to larger deals, that cycle will turn around. The whole idea behind IT services businesses, they have steady client base. Some of the businesses, bread and butter, regular business where you have to provide IT services. And from a cost optimization point of view, it actually helps people to offshore work to low-cost areas like India, which is the business model of IT companies, over a long period of time, this trend has been working very well. There will be cyclical blips. There will be issues where some sectors will not do well. And we have seen this in the past. So it's not something new for IT industry as a whole.
Raunak, in both your FlexiCap and the tax saver fund, I do see a fair amount of financials. You have ICICI Bank, you have HDFC Limited, Axis Bank, and I also see a lot of PSUs. You have Power Grid and Coal India. What would you think of PSU financials? I mean, PSU banks were on a tear. Do you think this is a good time to get in, given that everyone's structurally bullish on financials?
So from a financial investments point of view, we thought that private sector banks are a good place to be in because these are faster growing, better consumer franchises. In PSU category, we have not chosen to invest in the financial sector. However, on the other PSU side, which you mentioned, there are a lot of good companies in the PSU space which have been run very well. And I think they have been beaten down quite unfairly in the past several years. And some of the stocks were very attractive with great cash flow generation and also good dividend yields. So some of these companies are attractive from that point of view. But however, PSU banks will not find a place in the portfolio at this point.
Raunak, IRFC, I think you had some, y'all had got in early, right, out there. Now there's suddenly renewed talk of maybe a potential divestment. At this juncture, the stock is down more than 10%. But are you all still constructive on the stock? Will you allocate more money?
So IRFC is not part of our other equity schemes. It is only part of the conservative hybrid scheme, and that too in a very small portion. The idea behind conservative hybrid scheme is to have some equity which has high dividend yielding potential to the business. So IRFC was a part of that portfolio. But it's a business which has the same characteristics of any PSU business, and the divestment theme has been going on for a while. It remains to be seen how it plays out across several PSU companies. We look forward to seeing some divestments happen.
Okay, all right. Just a couple of more stocks, right? I mean, if you look at how the year has shaped up, one of the best performers this year has been ITC, and that's a part of your portfolio in both your FlexiCap as well as your tax saver fund. Now, do you think that the best performers of last year can do an encore this year, or is the outperformance, going to be restricted to just 2022? What's your best guess?
So hard to guess how the performance is going to be going ahead. The reason why we bought ITC was actually the valuations compared to other consumer businesses. The cash flow profile and the capital allocation changes that they announced, it seemed like a good idea to buy at that valuation. We have not added to ITC in the recent past. The stock has run up quite a bit, but it's not at a point where it has become very expensive and it needs to be sold. It's a very interesting business, continues to generate the cash flow that they generate, and continues to also improve the share of profits from the consumer space, which is a non-cigarette space. So we keep a watch on it. Anyway, we don't buy and sell ideas based on shorter term trends. It's a longer term hold for us, and it's a good capital allocate.
Okay, Raunak, we leave it at that. Thanks a lot for stopping by and speaking to CNBC-TV18. Well, that's PPFAS Mutual Fund with their view on the way forward for the market and how you should approach the new year.